The hidden logic behind capital allocation in Europe. Most good investments fail for one simple reason. There is a misunderstanding among most investors. They believe wealth is lost in crises, crashes, or market shocks. In reality, that's rarely true. Wealth in Europe is not destroyed in dramatic moments. It's eroded quietly through repeated allocation mistakes that look perfectly rational at the time. A few years ago, I observed two investment decisions inside a mid-sized European holding structure. Both looked reasonable. Both were approved by competent professionals. One prioritized visible growth. The other prioritized structural resilience. 1 year later, nothing collapsed on paper, but one portfolio had already started underperforming in silence. No alarm, no headlines, just gradual capital leakage. This is the part most investors never detect in time, because the real risk is not volatility. How capital actually gets allocated? 70% practical logic. Let's simplify how professional capital actually evaluates decisions. Not through complexity, through clarity. There are three filters that matter more than any spreadsheet. 1. Does the decision survive time, not just approval? Many investments look correct at the moment of execution. Very few remain correct after 3 to 5 years of changing conditions. So the real question is not, how profitable is this? It is, what breaks first when assumptions change? Inflation, regulation, demand shifts, energy costs, none of these are hypothetical in Europe anymore. A strong decision is one of that remains valid even when conditions are not friendly. 2. Cash reality versus accounting comfort. One of the most expensive illusions in investing is profit without liquidity. A structure can show strong earnings while gradually weakening its actual financial position. In simple terms, profit tells you what happened on paper. Cash tells you what survives reality. If cash generation does not support reported performance, the system is not scaling. It is accumulating hidden stress. Professional investors do not ask whether something is profitable. They ask whether it is self-sustaining without external support. And the filter number 3, the quality of assumptions, not the beauty of projections. Most investment narratives fail in the assumptions, not in the math. The numbers always work until reality enters the model. The real discipline is asking, what must be true for this succeed? How fragile are those conditions? Who is stress testing these assumptions? Weak capital decisions are almost always built on unchallenged optimism. Strong decisions are built on controlled skepticism. What professionals actually optimize for? At a more advanced level, two concepts separate experienced capital allocators from everyone else. Return on invested capital is not just a metric. It is a discipline filter. If returns do not exceed the real cost of capital in a sustained way, then growth is not creation. It is consumption of future optionally. In other words, a growing structure can still be destroying value. This is one of the most misunderstood dynamics in modern investing. Economic moat, structural durability. The most important question is not how a return is generated. It is whether that return can be defended. A true moat is not branding or positioning. It is a structural advantage under pressure. It answers one question. If competition increases tomorrow, does this position weaken or strengthen? If the answer is unclear, the advantage is not real, it is temporary. Capital discipline in a new European cycle. Europe is entering a phase where capital allocation matters more than capital availability. In easier cycles, many poor decisions look successful. In tighter cycles, they become visible. Not because the environment changed first, but because the discipline was never there. The key distinction is simple. Some investors optimize for opportunity. Others optimize for survival of capital through time. And over long horizons, those are not the same game. If you want to see how these principles work in real allocation scenarios, not theory, but actual decision structures used in high-level portfolios, I will be hosting a private session. We will break down how sophisticated investors evaluate risk, detect fragile assumptions, and identify structural strengths before markets confirm it. If this is relevant to your way of thinking about capital, you can join via the link below. This is not a mass session. It is designed for focused discussion among serious investors. Final thought: capital is rarely lost suddenly. It is lost through decisions that looked correct at the time.